In just 2 years, America's largest retirement community went from paradise to crisis. Homes that once sold in days now sit unsold for months. Monthly costs have surged far beyond what fixed incomes can absorb. Savings that took decades to build are being wiped out, quietly, methodically. This is The Villages. With more than 130,000 residents, it was once hailed as the gold standard of retirement living. Affordable, predictable, safe. A place where the math worked, where planning paid off. So what went wrong? How did a community designed for financial security become a high-stakes trap? Why are retirees finding themselves stuck in homes they can no longer afford and can't escape? The answers aren't found in reckless spending or bad decisions. They're buried in rising fees, collapsing insurance markets, underwater mortgages, and a system that was never stress-tested for failure. What's happening here isn't slow. It isn't isolated, and it isn't over. This is the story of how predictability broke, and what that means for anyone who believes retirement is supposed to be the safest chapter of life. Stay with me. Subscribe, and because this isn't just about one place in Florida. It's a warning. To understand why the collapse feels so shocking, you first have to understand why The Villages worked so well for so long. This wasn't an accident. It was engineered. The Villages was designed around a single assumption. Retirees live on fixed income, not growth income. Social Security checks arrive on schedule. Pensions rarely change. That means expenses must be just as predictable. And for years, home prices followed a clear ladder. Entry-level villas, mid-tier homes, and higher-end designer properties all sat within ranges retirees could plan around. Monthly costs weren't hidden or vague. They were laid out up front: mortgage payments, property taxes, insurance, amenity fees, and community development district bonds. Nothing moved quickly, nothing jumped unexpectedly. The Community Development District, or CDD model, played a key role. Instead of surprise tax hikes or special assessments, infrastructure costs were spread out and paid gradually through fixed annual bonds. Roads, utilities, recreation centers, all funded in advance. For retirees, that meant stability. Homeowners insurance was another anchor. Premiums were reasonable. Renewals were routine. Roof age mattered, but it wasn't a deal breaker. Coverage was something you budgeted once and rarely revisited. Because of this structure, housing costs typically consumed a manageable share of income. A couple receiving Social Security and a modest pension could cover their monthly bills and still afford groceries, healthcare, travel, and leisure. The math worked. The housing market reflected that confidence. Homes sold steadily, not frantically. Inventory stayed tight but balanced. Most residents weren't speculators. Nearly 80% counted home equity as their largest financial asset, not a flipping opportunity. The Villages wasn't just selling houses. It was selling certainty. And for a while, it's delivered exactly that. But systems built on predictability have one fatal weakness. When costs stop behaving, everything breaks at once. And that's where the story turns. Then came the moment that changed everything. In 2020 and 2021, the pandemic didn't just disrupt work, it reshaped retirement. Offices closed, cities emptied, and millions of Americans looked at their lives and made the same decision at once. Why wait? For many, Florida became the answer. And The Villages became the destination. Flights from New York, New Jersey, Ohio, and Illinois arrived full. Buyers showed up with cash, equity from homes up north, and a sense of urgency. What had once been a steady flow of retirees turned into a flood. Supply couldn't keep up. Homes that used to sell in a month were suddenly gone in days. Open houses became bidding wars. Buyers waived inspections, paid above asking, and signed contracts on homes that hadn't even been built yet, just to lock in a price before the next increase. Prices detached from history. Entry-level villas that once sold for the low 200s surged past $300,000. Mid-tier homes jumped by hundreds of thousands in less than 2 years. Designer homes crossed the $1 million mark, something that would have sounded absurd just a few years earlier. Developers responded the only way markets do during booms, by accelerating. New neighborhoods broke ground almost overnight. Construction crews worked double shifts. Each new phase launched at higher prices than the last, and still sold out. And psychologically, something dangerous took hold. People stopped asking whether prices made sense. They asked whether they'd miss out. The belief spread quietly but powerfully. Florida real estate doesn't go down. Retirement housing felt immune to cycles. After all, these weren't speculators. They were retirees. That made the boom feel safer, more rational, more permanent. But underneath the optimism, the fundamentals hadn't changed. Incomes were still fixed. Costs were still layered. And the entire system still depended on predictability. The market was running on momentum, not math. And when momentum fades, reality always comes due. For retirees, financial security isn't about upside. It's about control. And in the villages, control came from one simple equation: fixed income matched to fixed expenses. As long as that balance held, retirement worked. Then the math changed. Not slowly, not gradually, all at once. Mortgages barely moved, but everything around them did. Amenity fees rose year after year. Community development district bonds increased on schedule, locked in regardless of market conditions. Homeowners association dues climbed as maintenance and operating costs surged. But the real shock came from insurance. Premiums that once felt like a background expense became the largest line item in the budget. Policies doubled, then tripled. What had cost a couple $1,000s a year suddenly demanded $6,000, $8,000, even $9,000, with little warning and no negotiation. The result was brutal arithmetic. A home that once cost roughly $2,000 a month to maintain now demanded nearly $3,000. For households living on Social Security and modest pensions, that difference wasn't discretionary. It was existential. Housing began consuming 60, sometimes 75% of monthly income. There was no lever left to pull. Retirees can't simply work more hours. Many are already managing health issues that limit mobility and income options. Savings that were meant to last decades began disappearing in a few short years. IRA withdrawals filled the gap, but triggered new tax bills, accelerating the drain. This wasn't the result of poor planning. The numbers retirees had relied on for years were no longer valid. Budgets built on stability collapsed because the inputs changed, not by choice, but by force. And unlike younger homeowners, retirees didn't have time on their side. There was no recovery window, no next promotion, no future earnings growth to bail them out. What made it worse was the illusion of choice. Selling sounded logical until prices began falling. And even then, moving costs alone could wipe out what little flexibility remained. The promise of predictability had quietly vanished. And once predictability is gone, retirement stops being a phase of life and becomes a financial emergency. What finally pushed the villages from stress into crisis wasn't home prices, it was insurance. For years, homeowners insurance was a background detail, paid once a year, rarely questioned. But across Florida, that system began to fail. Hurricane losses mounted. Reinsurance costs exploded. Lawsuits piled up. One by one, private insurers pulled out of the state, and retirees felt the impact immediately. Renewal letters started arriving with ultimatums. Replace your roof or lose coverage. No discussion. No appeal. Even roofs in good condition were rejected once they crossed a certain age. Replacement costs ran $15,000 or more, money many retirees simply didn't have. When private insurers refused to renew, homeowners were pushed into Citizens, Florida's state-backed insurer of last resort. By the mid-2020s, more than a third of homes in the villages depended on it, an extraordinary number for a community of this size. Citizens offered coverage, but at a cost. Higher deductibles, limited protection, and the constant risk of special assessments if a major storm hit. For many, it wasn't a choice. It was the only option. The ripple effects were devastating. Buyers couldn't secure insurance. Lenders refused to close without it. Deals collapsed days before settlement. By some estimates, a quarter or more of pending home sales failed, not because of price disagreements, but because no insurer would write a policy at any price. Liquidity vanished. Homes that were technically for sale became effectively unsellable. Sellers cut prices, but it didn't matter. Without insurance, there was no transaction. Inventory piled up. Days on market stretched from weeks to months. For retirees who hoped selling would solve their budget problem, the door quietly slammed shut. Insurance wasn't just another rising expense. It was the gatekeeper to the entire housing market. And once that gate closed, the system stopped functioning. Prices fell. Confidence evaporated. And what had once been a predictable retirement ecosystem froze into uncertainty. This wasn't a housing correction. It was a structural breakdown, triggered by a system retirees never expected to fail. By this point, many residents of the villages reached a terrifying realization. They were stuck. Staying meant watching their finances bleed month after month. Insurance premiums kept climbing. Fees never stopped. Savings meant to last a lifetime were being drained just to keep the lights on. But leaving wasn't a solution either. Home values had fallen, especially for those who bought near the peak. Many owed more than their homes were now worth. Selling would mean locking in a loss, sometimes $50,000 or more, money that simply didn't exist in their accounts. Even if the numbers worked, the logistics often didn't. Moving costs alone could reach $10,000 to $20,000. Downsizing wasn't guaranteed. Renting wasn't easy. And strict community rules limited the ability to rent out a home temporarily to buy time. The bills followed the owner no matter where they lived. Then there was health. Many residents were in their 70s or 80s, managing chronic conditions. Their doctors, specialists, and Medicare Advantage networks were local. Relocating meant starting over medically, a risk many couldn't afford to take. For some, even the physical act of moving felt impossible. Social ties tightened the trap further. The villages isn't just housing. It's hundreds of clubs, daily activities, and informal support networks. Neighbors drive each other to appointments. Friends check in after surgeries. Leaving didn't just mean changing addresses, it meant losing a lifeline. And the psychological toll was heavy. Bills stacked up on kitchen tables. Credit cards filled the gaps. Anxiety became constant. Some residents delayed medical care. Others skipped prescriptions. Foreclosure notices quietly appeared in court records, not because of recklessness, but because the math no longer worked. This was never supposed to happen. These were people who planned carefully, who followed the rules, who did everything right. Yet they found themselves caught between two impossible choices: stay and slowly run out of money, or leave and collapse financially all at once. This is what a broken system looks like, not in headlines, but in living rooms. And it raises a deeper question. If this can happen here, where else can it happen next? What's unfolding in the villages is bigger than one community. It's a warning signal. For decades, retirement planning focused on portfolios, withdrawal rates, and market risk. But this crisis exposes something far more uncomfortable. Some of the biggest risks in retirement don't sit in your investment account at all. They sit in insurance markets you can't control, in fee structures you can't renegotiate, in communities where governance was designed for growth, not resilience. The residents here didn't speculate, they didn't chase leverage, they followed the rules. And still, the system turned against them. That should make all of us pause. Because if predictability can collapse this fast in a place engineered entirely around stability, then retirement risk needs to be redefined. So here's the question I want you to think about, and I want you to answer in the comments. When you plan for retirement, what do you worry about most? Market volatility, healthcare costs, or risks you can't even see yet? There's no right answer. But the conversation matters. Quick disclaimer. This video is for educational and informational purposes only. It is not financial or investment advice. Always consider your own circumstances and consult a qualified professional before making decisions. If this analysis helped you see retirement risk differently, subscribe to the channel. Here we break down the hidden forces shaping markets, money, and long-term financial security clearly, calmly, and without hype. And if you know someone planning retirement or considering a move to Florida, share this video. Sometimes the most valuable insight is the one you hear before it's too late. I'll see you in the next one.